Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class, where we're going to be talking about how to trade range bound markets. Okay, so without any further ado, let's dive right into it. Okay, so first things first, if you've been following our ITU Forex classes, you know that the market, the financial markets that is, tends to exist in one of three phases. Okay, so one of the phases is when you have a trending market. So let me quickly type that in, okay? So one of the phases is a trending market phase. Trending market phase, okay? And after a trending market phase, next to it is what we refer to as a ranging market phase or a range bound market phase, okay? And this is what we're going to be talking about today because we've been talking about how to trade a trendy market phase for almost, forever with these classes. The reason is because it's much more easier for traders to squeeze profits out of the market through through trading trending market phases. That's a tongue twister, by the way. So the third phase, which is a little more difficult to trade, but if you are able to trade it profitably with an edge that is going to stack the odds of winning in your favor, then you can get a really, really good high reward to risk trades. Okay, because you're basically risking nothing to make very, very big amounts of profits, depending on how the market moves. Okay, so the third is the consolidating market phase. Okay, consolidating market phase. Now, just to do a quick primer, because it's possible that some of you are just joining us for the first time, okay? So when we talk about trending market phases, it's broken down into two. The first is an uptrending market phase. And usually the way an uptrending market phase is, the way you identify uptrending market phases is when the market is forming higher highs and higher lows, okay? So this is the characteristic nature of an uptrending market phase. Price is going to consistently form higher highs and higher lows. So one of the ways traders take advantage of this type of market situations, the first is to trade breakouts. So for example, when price was making this market structure of an uptrending market, it was making higher highs and higher lows. As you can see, let's assume this was a high and this was, let's say this was our origin low. Okay, so when price moved from this low to form this high, eventually it bounced off of this resistance area because it couldn't move any further, and then it pulled back. Now this pullback is a low, but we call it a higher low because when you compare the level where this pullback is to the previous low, the origin low that I said earlier on, you're going to see that this low is actually higher than this low. And the same thing could be said for this also, because if this was our origin point and this was a high, then obviously eventually when price broke above this resistance area, it went on to form a brand new high, which is higher than the previous high. And that's what we mean by the formations of, for a uptrending market structure, we get the formations of higher highs and higher lows, okay, consistently. So depending on how strong this trend is, price is usually going to continue forming these higher highs and higher lows because in an uptrending market, it is expected that if the uptrend is healthy, price is going to continually break above the resistance area to form brand new highs, and it's going to find it consistently difficult to either test previous lows or even break below them. Because if price is really in an uptrend, then it has no business breaking below higher lows, okay? So there are two ways to trade this type of markets, okay? It's either you trade them based on breakout trading strategies, which is, since this is an area where price found it difficult to break above previously, when price eventually gathers enough momentum to break above this level, then you would want to be involved with a trading position here because the breakout is signaling that price is looking to form a brand new high. That's the assumption, okay? And then this low, okay? There's the second method that you use to trade this trending market phase, okay? And that's known as the pullback trading method. Remember I told you that whenever price is in an uptrend, it's usually not going to move up in a straight line. It's going to move up and then it will pull back a bit. Up and then it will pull back a bit. In other words, price is going to form higher highs and higher lows, higher highs and higher lows. As long as the trend remains intact, it's going to continue doing that, okay, in a perfect world. Now, the thing is, when price makes this pullback, if this is really a good pullback that is signaling to us that there's still strength with this bullish move, then price has no business breaking below this low, which is our origin low for this example. Or if this was a pullback, then price has no business breaking below this higher low. Okay, because if truly this is just a pullback, then price is supposed to make higher highs and higher lows, not lower lows. Because if this low was to break below this low, then this would be a lower low. Okay, so the idea is some excuse me, some traders, instead of waiting for price to make a breakout and then they will take a trade in the direction of the breakout, they would much rather prefer for price to pull back, and then when it starts showing signs of rejection, like long tail candlesticks or bullish engulfing candlesticks in the case of an uptrending market or whatever, they are now going to decide that might just be the end of the pullback, and then they will place a trade, okay, assuming that is the end of the pullback, and then they'll based on their risk management, if they are using fixed risk management, like risking 1 to make 2 or whatever the case might be, then they'll do that and go for whatever profit target they're aiming to get. This was meant to be a quick primer for how we trade the trending market phases. The same thing could be said for a downtrending market phase. It's just flip the script and it's the opposite, okay? For a downtrending market phase, usually price is going to form a low. It's going to start from, let's say, an origin point high, for example, and then it's going to form a low. And then it's going to form a high, which is ideally supposed to be lower than the origin point high, okay? Then it's going to form a low, which is going to be lower than the previous low. And then a high, which will be lower than the previous high, low, lower than the previous low. Continuously, it's going to keep doing this as long as the downtrend remains intact. Again, there are two ways to play this. It's either you're going to be the breakout trader who is going to place pending orders. In this case, a sell stop pending order, waiting for price to break below this low where price got rejected at previously, and then you're going to take a short trade in the direction of the trend. Or you're going to be a pullback trader who is going to wait for price to pull back. Ideally, if the trend is really a strong downtrend, then it has no business, price has no business breaking above this previous origin point high. So you're maybe going to place your stop loss here if you're trading with a conservative stop, or if you're doing so with an aggressive stop, you might decide to take, test it out with 1 or 2 trades. And then if price eventually breaks above this level, you're no longer interested in the trade. But this is basically how it's being played out. Okay. This is how we trade trending market phases. Now, for the meat and potatoes of this week's class, which is how to trade range-bound markets. Well, trading range-bound markets is completely different to how we approach trending market phases, because first things first, a range-bound market is the market phase where price is not forming higher highs and higher lows successively, okay? Because there is almost no trend in the market, so price is finding it difficult to break above resistance to form a brand new high, or to break below support to form a brand new low. When we have a range-bound market, usually what tends to happen is price is going to be bouncing off of levels of horizontal support and resistance. Okay, this is an example of a range-bound market phase. You can see that before price started ranging, it was actually in an uptrend. It was forming higher highs and higher lows, higher highs, higher lows, higher highs, obviously, till we reach this area, okay? And then price now started finding it extremely difficult to form higher highs. You can see when it formed this high, it battled breaking above this level, but it failed to do so. Eventually, it started bouncing off of this level of support, and then when it reaches this resistance, it bounces off of it, and then when it comes back to support, it bounces off of it. It was finding it difficult to break above the resistance area here, this barrier here, and it was finding it difficult, extremely difficult, to break below this support barrier. Okay, so how do we trade this? Well, one of the very, very good ways to trade it is to use it as support and resistance areas. Okay, so for example, since in the past, let's start our price analysis from here, okay? Since in the past, price was finding it very difficult to break above this resistance area. You can, why do I say, it's not like I just picked this thing, okay? And I just said price was finding it difficult. The reason why I said price was finding it difficult is when I zoom in on the charts, you can see clearly when you look at these candles that when price reached this area, instead of decisively breaking above it with very strong bullish engulfing candlesticks, it found it difficult to do so. In fact, we had a bullish engulfing candlestick here, but then immediately price bumped into this resistance area. It formed a hanging man candlestick, telling us that it's finding it difficult to break above this resistance area and keep moving up. And then right next to that hanging man candlestick, we had the formation of a bearish engulfing candlestick, which is showing us that we almost have a reversal in the market. And so when price came to this level, it couldn't break above this level, and then it reversed and started moving down, only for it to come and bounce off of this support level. So this is the reason why we said price was finding it difficult to break above these levels. This is a confirmed resistance area. So when we've spotted our confirmed resistance area, if we are trading based on support and resistances, when the market is in a range-bound market phase, how do we approach it? The way we approach it is we identify our levels on the chart, and then we sit and wait and do absolutely nothing until price reaches that level again. So let me show you an example, a quick little example. You can see earlier on, price came to this support area, and then it tried to break below this area, but it failed to do so, and which led to the formation of this long tail candlestick, this doji, if you would call it that. And then immediately we had the reversal candlestick, this bullish engulfing candlestick. So this was something that looked like a successful rejection of price from this support area, and then price bounced off to start moving up. Now, if we're trading based on how to trade range-bound markets properly, then we're going to identify this level, and then we're going to sit on our hands and do nothing. We'll just wait. Wait for what? We are waiting for price to come back to this level where it got rejected in the past, and then we're waiting to see how it reacts to this level. We don't just, this is very important, okay? This is very, very important. We don't just buy or sell when price comes to a level where it found difficulty breaking above in the past. So in this case, an example would be price found this support level difficult to break in the past. And then just a couple of weeks after that, because this is the daily time frame, obviously, price came back to this level. But then instead of just buying or selling when price reaches this level, we want to wait and see how price reacts to this level. And exactly that's what we had here, because price got rejected in the past at this level, and then when it revisited this level, instead of breaking below this level, it now did the same thing it did in the past. We had a kind of like a rejection candlestick forming here, and then we had a very good bullish engulfing candlestick forming. And so in this case, we could have easily taken a trade here. Okay, if we're trading off of this time frame itself, then we would have easily taken the trade here with a stop loss just below this level. And if we're aiming for a 1:2 or 1:3 or the next resistance level or whatever the case might be, you can see that this would have been a trade that would have worked out. This is an example of a trade that worked out, but I want you to pay close attention to what I'm showing you next, which is this trade. I would have been risking 1 to make 3, but let's not even say I risked 1 to make 3, because it's almost as if I'm cherry picking here, because price just reached the 3R and then eventually it came back. So let's not even do it like that, because this is not realistic. Okay, so let's assume we're risking 1 to make 2, which is more realistic in this case. Okay, why am I doing this? The reason is because every single lesson, if I can remember properly, okay, almost every single lesson, let me put it that way, I always like to emphasize to you guys that you need to aim for a profit target which is at least 2 times or 1.5 times, or much more than that, higher than what you're risking on the trade, on every trade you take. The reason is because trading is a game of probabilities. No matter how good the trading strategy we are using is, we're never, ever, ever going to take 100% winning trades every single time, because we don't have a crystal ball. And if we don't have a crystal ball, then we don't have 100% certainty about what is going to happen in the future. And so because of that, we need to protect ourselves by practicing proper risk management. No matter how good a trading strategy is, if you don't couple it together with the proper risk management and the right mindset, you're still going to struggle to make money through trading. There are countless trading strategies out there on the internet that are very good trading strategies, but because people fail to use those trading strategies with proper risk management and the right mindset in the sense that even though the trading strategy might be a winning trading profitable trading strategy, it could still have 3, 4, 5, 6, 7 losing trades in a row. And so when you encounter those losing trades, if you don't have the right mindset, then you're going to start making all sorts of trading psychology mistakes, like revenge trading, like trying to double down, like trying to, risk more, all of those things, which are just going to eventually harm you and harm your trading performance. And so when you're trading, especially if the trading strategy that you're using has a win rate which is less than 50%, then it is imperative. It is very, very important for you in such situations to aim for like 2 times what you're risking on the trade. The reason is because if you take trades and you're risking 1% and you're aiming to make like 2%, for example, and you take like 30 trades or 100 trades, eventually, even if you were to lose half of the trades you take, because your profits are much larger than the losses from your losing trades, eventually you'd end up being profitable. And that's the reason why risk management is very important. So yes, this trade example that I showed you was a winning trade, but I still want you to bear in mind that even if it was not a winning trade, the idea is, if we take a large sample size of trades and we are doing proper risk management and we have our mindset the way it's supposed to be, then because we are aiming for much bigger profits than what we are losing on average, eventually we'd still end up being profitable. Okay, so let's move on to another example. This is the example of the one trade, and this would have been a trade that worked out, hit our profit target. But let's even say you missed taking this trade setup. So you identified this support area based on the daily time frame. And then when price reached this level, and then it got rejected at this level, trying to bounce off of this level again, it found it difficult to break below this level and keep moving up. But you were not there to take advantage of this trade. And so you missed out on this trade. Guess what? Price revisited this level, and yet again, it found it difficult to break below this level. So this was 1 touch, 2 touch, 3 touches. When price came to this level, it couldn't break below it, and then we had this price rejection candlestick, and then what seems like what do you call this candlestick? This bullish engulfing, because this candlestick, even though it's not a very big bullish engulfing candlestick, it still managed to close above its body. It still managed to close, engulf the body of this previous candle next to it. Okay, so let's assume you missed this trade setup, but you, as a proper price action trader, okay, you identified when price rejected here, and then you identified that when price came back to, give you a trade setup here, you missed out on it. But now price is doing the same thing here, and you're on the chart. And so in this case, you just take another trade setup. Place your buy stop at the close of this candle. Place your buy trade at the close of this candle. And then place your stop loss just below this level, because this is the area that if for whatever reason price was to break below this area, then our support is no longer holding. So this range bound market is, maybe it might start trending. And so when it's trending, we're not trading with this type of trading strategy. We're going to trade with something opposite. Okay, so what we have here, so you can see exactly, this would have been our entry. This would have been where we would have placed our stop loss. And if we're aiming for our 1:2, then our profit target would have been hit somewhere here. In fact, let's assume just for example's sake, that we're aiming for the high. Okay, this was the high where price got rejected at previously. So somewhere around here. Okay, you can see that this would have been a 1:4 trade. But again, I like keeping it simple because we're seeing this with the benefit of hindsight. So we see that price came all the way up here, and so we might say, okay, our profit target, if it was here and all of that thing, okay? But if we're going for a 1:2, easily price would have hit our 1:2 somewhere around here, okay? Somewhere around here. So now this is it for our long trade examples, okay? Now, what about this one? The reason why I'm showing you this example is because you can see that when price came to this price level, it actually bumped into resistance. And so it couldn't break above this level. It came to this level. Instead of continuing to move up like it did in the past, immediately it came to this level. It found it difficult to break above this level. And so we had the formation of a hanging man candlestick, just like I told you earlier on. And then right after the hanging man, we had the formation of a bearish engulfing candlestick. And so this would have been where price rejected this level, assuming we're identifying it for the first time, okay? So let's say this isn't the place we take the setup, but this is when we identify that price is reacting to this level. So as a price action trader, let's say we're trading this range bound market, you would have pinpointed that, okay, price respected this level in the past. And so you're going to wait. In this case, if you waited from here to when price revisited this level somewhere here, it would have been around just over 2 months, because this is the daily time frame, obviously. Okay, if you're trading the lower time frames, then it's usually not going to take this long for trade setups, but also the accuracy of your trade setups might not be as high as the ones for the higher time frames. It's a trade-off. Obviously, you need to look at what fits your trading style best, what fits your personality, and then go with that and stick with it. Okay, so assuming you are trading off of the daily time frame for this particular pair, you can see that it actually took just over 2 months. I think 2 months and 16 days, 2 months, 2 weeks or so. Okay, for price to revisit it, revisit this area where it visited previously. Okay, so what does this have to do with anything? Well, what this has to do with anything is that previously, you can remember that price came to this level and it got rejected. And so if we're trading based on our range-bound trading strategy, obviously, we're going to be waiting patiently for when price is going to revisit this level and then look for signs that this level is going to hold. Then we're going to take a short trading position. And obviously, this happened because when price bumped into this level where it got rejected at in the past, you can see that after it got rejected and formed this long wick candlestick, immediately we had the formation of a bearish engulfing candlestick. So we would have taken a short trade setup somewhere around here. Why? Because you can see that when we place this trade, when we take this trade at the close of this candle and place our stop loss above this resistance area, the reason being, if price was to hold on to this, if price was to remain below this resistance area, then this range-bound resistance is likely going to hold. And so if we took this trade here, aiming for a 1:2 risk to reward ratio trade, you can see that price would have hit our profit target somewhere around here. So this would have been another winning trade. So we would have taken a winning trade here, taking a winning trade here, taking a winning trade here also. But like I keep telling you, we will not take winning trades 100% of the time. And that's why using proper risk management is very, very important. Again, you can see that this is a level that held multiple times. It held here, and then eventually when price came again one more time after we took this trade, when it came to test this level again, you can see that when price came to this level, it couldn't break above it. And then eventually, we had the formation of these long wick candlesticks. And so when we had this reversal candlesticks form, this is yet another short trade setup that we would have taken. So after the formation of this hammer candlestick, we would have taken a short trade at the close of this with a stop loss somewhere just above this resistance area, and then aiming for a 1:2. And you can see that again, price would have hit our profit target. Okay, so it's kind of simple to see. We had back-to-back, back-to-back wins of like 3 or 4 trades. But the same thing can happen in the opposite direction. We could have had back-to-back losses of like 3 or 4 or 5 trades. And that's why psychology is important and risk management. Because just because I showed you these examples of trades that worked out, there is definitely going to come a point in time where you're going to identify trade setups that you would have back-to-back losses. So are you just going to dump the trading strategy because of that and miss out on all of the beautiful trade setups that are going to come in the future? Or are you going to stick to the plan? Just trade with proper risk management, aiming for a good risk to reward ratio. 1:2 is more than enough for you. Because if you're trading with a 1:2 risk to reward ratio, after taking something like 100 trades, even if you were to lose more than half of the trades that you took, like maybe 55% was all losses and then 45 trades were winners, you'd still end up being profitable. Okay? It's just a numbers game at the end of the day. So you need to understand this. Yes, I showed you examples of trades that worked out, but that does not mean that it's always going to work out 100% of the time. Okay, there are times when trades are not going to work out the way you expected them to, and this is one of the most beautiful ways for you to trade range-bound market conditions. Okay, and so this pretty much brings us to the end of this week's edition of the ITU Forex class. But as usual, before we wrap up the class, I would like to use this opportunity to invite you guys, okay, to take advantage of our ITU bots, which are a suite of trading robots, expert advisors, which are designed to identify low risk, high probability trade setups for you, and then place those trade setups with proper risk management depending on the settings you use, which we'll walk you through how to do step by step. Okay, so if you're interested in trying them out, please reach out to us on the socials or drop a comment in the comment section of this video, and then we'll gladly reach out to you on the steps of how to set everything up. Okay, so once again, Thank you guys for taking time out of your busy schedules to come to this class. I really appreciate it. And I hope you got value from this video, okay? I look forward to seeing you guys in next week's edition of the class. And in the meantime, go out there and crush the markets, okay? Please, you guys should always take advantage of what you're learning in this class and practice it. Practice, practice, practice. Like, you know, like they say, practice makes perfect. So don't just come to the class and just listen to me blab and then, you know, go out there and do nothing. Listen to me, take notes, go out there, test it out on historical price data, test it out on demo accounts, test it out on simulation accounts, and then eventually you're going to build a solid trading edge which would give you an unfair advantage in the markets. So please, guys, don't forget to always take advantage of these classes by scribbling notes with what you're learning, going out there to practice and improve on what you're learning, okay? And again, if you're interested in any of our ITU suite of bots, reach out to us on the socials and we'll be more than glad to help you set everything up step by step. I look forward to seeing you guys in next week's edition. God bless you. Have a wonderful rest of your trading week. Cheers. Go out there and crush the markets, okay? Thank you. I'm rooting for you.